You don't need to be an expert to invest smart. You don't need a finance degree, insider knowledge, or the ability to predict the market. What you truly need is a simple structure, a clear set of rules, and the patience to stay consistent over time. Many people never start investing because they believe it is too complicated. They see thousands of stocks, endless charts, technical terms, and conflicting opinions. As a result, they feel overwhelmed, confused, and afraid of making mistakes. Others do start, but without a plan. They jump from one idea to another, chase trends, react emotionally to headlines, and eventually lose confidence. This cycle leads to frustration and poor long-term results. The reality is that most successful investors are not smarter than everyone else. They simply follow a clear system and stick to it for many years. Simplicity is often the greatest advantage in investing. That is where the 70-20-10 portfolio rule comes in. The 70-20-10 rule is a simple framework designed to balance stability, growth, and opportunity. It divides your portfolio into 3 clear parts, each with a specific role. 70% of your money is invested in ETFs. 20% is invested in growth stocks. 10% is invested in crypto. Each part serves a different purpose. Together, they create a portfolio that is easier to manage, easier to understand, and easier to stick with over time. The first and most important part is the 70% allocated to ETFs. ETFs, or exchange-traded funds, are investment vehicles that track a group of assets instead of a single company. When you buy an ETF, you instantly gain exposure to many businesses at once. This diversification reduces risk. If one company performs poorly, it has only a small impact on your overall portfolio. If others perform well, their growth helps offset losses. For example, an ETF that tracks the S&P 500 represents 500 large companies across different industries. Some companies will struggle, others will thrive, but together they reflect the long-term growth of the economy. Historically, broad market ETFs have delivered consistent returns over long periods. They experience volatility, sometimes significant volatility, but over decades they tend to grow. This is driven by innovation, productivity, population growth, and economic expansion. The 70% ETF allocation is the foundation of the portfolio. It is not designed to be exciting. It is designed to be dependable. This part of your portfolio should help you stay calm during market downturns. When markets fall sharply, diversification helps limit damage. When markets recover, this portion participates fully in the rebound. Many investors underestimate how important this emotional stability is. Panic selling during market crashes is one of the most common and costly mistakes. A strong ETF foundation makes it easier to stay invested when fear is high. The 70% allocation is also ideal for busy people. You do not need to follow daily market news or analyze individual companies. You simply invest regularly and allow time to work in your favor. The second part of the portfolio is the 20% allocated to growth stocks. Growth stocks are companies expected to grow faster than the overall market. They often operate in expanding industries such as technology, artificial intelligence, renewable energy, healthcare innovation, or digital services. These companies usually reinvest profits to expand their business rather than paying high dividends. As a result, their stock prices can grow rapidly, but they can also fluctuate significantly. Growth stocks carry more risk than broad market ETFs. They are more sensitive to interest rates, economic conditions, and investor sentiment. That is why they are limited to 20% of the portfolio. This allocation is large enough to improve long-term returns, but small enough to control risk. Think of this part as the performance engine of the portfolio. It adds acceleration, while the ETF portion provides stability. A common mistake beginners make is allocating too much money to growth stocks, especially during bull markets. When prices rise quickly, it is tempting to increase exposure. However, this often leads to large losses when conditions change. The fixed 20% allocation prevents this behavior. You participate in growth, but you avoid overexposure. When selecting growth stocks, long-term fundamentals matter more than short-term hype. It is important to understand what the company does, how it makes money, and why it may continue to grow over the next 5 to 10 years. You do not need many growth stocks. Holding a small number of high-quality companies is often more effective than owning dozens of speculative names. Some investors prefer to use growth-focused ETFs instead of individual stocks. This approach provides diversification within the growth segment and reduces the need for constant monitoring. The final part of the portfolio is the 10% allocated to crypto. This is the most volatile and controversial component. Crypto assets can experience extreme price swings in short periods of time. Because of this volatility, they are not suitable as a core investment for most people. However, crypto also offers asymmetric upside. This means the potential gains can be much larger than the amount invested, while losses are limited to that allocation. By limiting crypto to 10%, you control risk while keeping exposure to potential innovation and growth. If crypto performs exceptionally well, it can meaningfully boost your portfolio. If it performs poorly, the overall impact remains limited. This allocation also helps manage psychological pressure. Many people feel fear of missing out when crypto prices rise rapidly. A fixed allocation allows participation without emotional overcommitment. The key is to treat crypto as optional, not essential. It complements the portfolio but does not define it. The true power of the 70-20-10 rule lies in discipline. The rule removes constant decision-making. You always know how your money is allocated and why. Over time, markets will change and allocations will drift. Some assets will grow faster than others. This is normal. Rebalancing is the process of restoring the original allocation. For example, if growth stocks or crypto grow beyond their target percentage, you sell a portion and reallocate to ETFs. Rebalancing forces you to sell assets that have risen in price and buy assets that have lagged. This happens automatically, without emotional judgment. Rebalancing once or twice a year is usually sufficient. Frequent adjustments are unnecessary and can increase stress. Another important principle is consistency. Trying to time the market is extremely difficult and rarely successful over long periods. Instead, many investors use dollar-cost averaging. This means investing a fixed amount of money at regular intervals, regardless of market conditions. This approach reduces the impact of short-term volatility and builds a habit of disciplined investing. The 70-20-10 rule works perfectly with this method. Each time you invest, you simply divide the amount according to the same percentages. No guessing, no emotional decisions. Emotions are one of the greatest risks to long-term investing success. Fear during downturns and greed during rallies often lead to poor outcomes. A simple rule-based portfolio acts as a psychological anchor. It helps you stay focused when markets are noisy and unpredictable. Long-term investing is not about perfection. It is about patience, discipline, and resilience. Markets move in cycles. There will be periods of strong growth, periods of stagnation, and periods of decline. A balanced portfolio allows you to remain invested through all of them. The 70-20-10 rule is especially suitable for beginners and busy people. It does not require constant attention or advanced knowledge. It provides clarity and structure. Over time, confidence grows. You understand why your portfolio behaves the way it does. This understanding reduces anxiety and improves decision-making. In the end, successful investing is not about finding the most complex strategy. It is about finding a simple system that works and following it consistently for years. Simplicity encourages discipline. Discipline allows compounding to work, and compounding, given enough time, is one of the most powerful forces in finance. If you focus on clarity, consistency, and long-term thinking, you give yourself a strong advantage. The 70-20-10 rule offers a clear path for doing exactly that.